Welcome back to another update of Smart Stock Sam. If you are really interested to make money out of US stocks, do not forget to subscribe and tap bell icon, because on this channel I deliver timely updates before crowd arrives. Alright, here we go.
Wall Street is currently at war over a single ticker. On one side, Jim Cramer is sounding the alarm, warning investors to stay away. On the other, the internal numbers are projecting a growth curve so aggressive it almost looks like a typo. A 6,500% revenue explosion in just 24 months. Is the legend wrong, or is the market walking into a massive trap? Today, we are performing a deep tissue dissection of RZLV Stock. Cramer's wrong? Here's what the numbers say. We are looking at what is arguably the most polarized battleground stock in the entire AI sector right now. On one side, you have a management team that is, to put it mildly, hyper-aggressive and promotional. On the other, you have a set of fundamentals that look like a disaster zone. We are witnessing a massive chasm between stagnant past performance and a future guidance that sounds like science fiction. Is this a revolutionary AI powerhouse being misunderstood by the old guard like Jim Cramer? Or is it a classic case of overpromising and under-delivering? The hype is loud, the headlines are flashy, but there is a hidden structural deficit buried deep within the SEC filings that every retail investor needs to see before they even think about touching this ticker. To understand this polarized play, we have to look past the press releases and stare directly at the staggering delta in their core financials. Right now, the cold, hard reality of RZLV is modest, some might even say microscopic. RZLV has just $5.3 million in trailing 12-month revenue. In the world of tech, that is micro-cap territory. It's practically a rounding error for the giants they claim to compete with. Yet, management isn't just optimistic, they are defiant. They are guiding for $350 million by 2026. Do the math with me, that is a 6,503% increase required to hit the mark in 2 years. But here is the kicker that most people miss. Their operating margin is currently negative 3,031%. In plain English, RZLV is currently spending over $30 on overhead, marketing, and development for every single dollar of revenue they actually bring in. This isn't just burning cash, it's a localized inferno. The entire business model is a massive, high-stakes bet that future growth will eventually move fast enough to outpace a staggering $165.8 million operating expense base. If those numbers sound fundamentally impossible to you, you're not alone. But before you write this off as a no-go, you'll want to hear how analysts are justifying the bull case using a completely different metric, one that changes the entire perspective. You see, the analysts who are shouting from the rooftops aren't looking at trailing revenue. They're focused on velocity. This is where the story shifts. The company claims they didn't just grow, they exploded, moving from $0 to $90 million in annual recurring revenue in less than 12 months. They claim to have over 100 enterprise customers currently in the pipeline. Their target? A $500 million ARR run rate by the end of 2026. Now, how does this matter so much? Because RZLV boasts a 95.6% gross margin. If they actually hit that scale, the cost of delivering their service is almost nothing. This is the agentic commerce dream, a scalable, low-cost AI engine that functions like a digital toll booth. If they hit their targets, this company flips from a cash incinerator to a high-margin money printer literally overnight. It's the ultimate J-curve recovery. But as any seasoned investor knows, high margins don't matter one bit if the company runs out of oxygen before they reach the summit. And that brings us to the sizzle versus steak problem that is currently haunting the stock price. If you look at the bear case, it isn't just brutal, it's terrifying. We are looking at a net loss of $217.5 million. But for the retail shareholder, the real pain isn't just the loss, it's the dilution. Management has been what I call a serial seller of its own equity. The shares outstanding have skyrocketed by over 91% in just 1 year. Every time you buy a share, you're getting a smaller and smaller piece of the pie. This has created a negative equity position. Look at the balance sheet. Their liabilities tower over their assets like a skyscraper. This means there is no asset floor. In a normal stock, if things go south, you have buildings, patents, or cash to catch the falling knife. With RZLV, if that hyper-growth narrative ever stalls, there is no safety net. If the AI dream doesn't materialize exactly as planned, there is nothing left for the shareholders but a hole in the ground and a lot of what-ifs. Now, you'd think a setup that risky would scare off the smart money and the institutional giants, right? Well, that is where this story takes a very weird, very expensive turn. While retail investors have been panic selling through 32% weekly price declines, the heavy hitters are moving in the opposite direction. Institutional giants like Citadel and Alyeska haven't just dipped their toes in, they've stepped in with size. They recently participated in a $250 million cash infusion, taking an early stake at roughly $2.28 per share. This creates a fascinating conflict. On one hand, you have Jim Cramer issuing hyper-promotional warnings, essentially telling investors to run for the hills. On the other hand, you have Roth MKM putting out a price target of $12.50. The institutions are betting that this $250 million isn't just a band-aid, it's the runway Resolve needs to finally turn the corner and prove the doubters wrong. They are betting on the tech, while the market is currently terrified of the balance sheet. So, how does this actually play out for your portfolio? It all comes down to three critical success factors that will decide if RZLV is a multi-bagger or a zero. For Resolve to justify its valuation and prove Cramer wrong, they must execute flawlessly on three fronts. First, velocity. Those 100-plus enterprise pilots have to convert into paying contracts immediately. Second, monetization. They have to prove that agentic commerce isn't just a buzzword, but a revenue generator. And third, integration. They've been on a shopping spree, and they have to stitch their recent acquisitions together without the wheels falling off. This is what we call a binary bet. Scenario A, they hit that $350 million target, they successfully integrate their mergers and acquisitions, and the stock becomes a free cash flow machine. In this world, the valuation sits comfortably between $11 and $15, that's a 280% to 400% upside from today's levels. Scenario B, the integration fumbles, the enterprise adoption stalls, and the massive cash burn continues until the $250 million is gone. In that scenario, you aren't looking at a dip, you're looking at a total capital loss because, as we discussed, there is no equity floor to save you. RZLV is the definitive battleground stock of 2025. It is high risk, high reward, and high drama. If you're getting in, you have to be prepared for an all or nothing outcome. The numbers tell a story of a company on the edge of greatness or the edge of a cliff. The question is, which one do you believe? If you found this breakdown helpful, hit that subscribe button and let me know in the comments. Are you riding with the institutions, or is the dilution too much to handle?
Alright, that's the update. If you want more quick fact-based insight like this, subscribe and tap the bell icon so you don't miss the next one. Drop your thoughts in the comments, and I'll see you in the next update on Smart Stock Sam.